The value of financial statement information. So what's the point of all this records keeping, all of this journal entries, all of these financial statements, such as income statement, uh, balance sheet, and the statement of cash flow? What's the value in it? Well, besides like the clear obvious things, like one of the things that you can do with this information is this thing called ratios. Ratios are useful for financial analysis. So then you can use these ratios to calculate a specific number, and then you can use that number to do analysis, for example, horizontal or vertical analysis. Horizontal analysis is when you compare 2 years of financial information. For example, here the Lincoln Company, as you can see, horizontally is being analyzed by these 2 years. You guys understand? This is horizontal analysis. Now, what is vertical analysis? Vertical analysis. Give me a moment here. Vertical analysis, percentage analysis of the relationship of each component in a financial statement. So for vertical analysis, you have to convert that to percentage, in which that percentage can be analyzed. Okay. So, like, there's like this entire thing that we went through. These financial entries, different types of entries, cost of goods manufactured, how to calculate various things, how to like create these financial documents. But now, besides it being used for like things such as a 10K or a 10Q, like one of the things that it can be used for is ratios. Like ratios for to even do more analysis between companies, compare companies based off of their ratios, for example, is one thing that you can do. So like these ratios are analyzed and evaluated across like these 3 dimensions. The first dimension is liquidity. Liquidity is evaluating a company's ability to convert assets into cash. Like how easy is it for this company to convert its assets into cash. Okay. For example, like one of those ratios is like the quick ratio. If you guys want to see, like for that ratio, the quick assets over current liabilities. It's a measure of the company's instant debt paying ability. Quick assets. So like for quick assets, it would be pretty much like cash and accounts receivable would be quick assets. Because like things such as like equipment, land, those things aren't as easily liquid. Okay. And then you divide that with current liabilities, and then that's how you find the quick ratio. So like there's several ratios for liquidity. There's working capital ratio, there's current ratio, there's quick ratio, there's accounts receivable turnover, day sale and receivable, inventory turnover, day sale and inventory. Some of these we aren't going to go over because it's not on the I don't want to say like it's on the thing or not. I'm have to look it up. But it's also good to know, just to like know that it's there even if it's not on the thing. And solvency, evaluating a company's ability to make its interest payments, right? How likely is it for this company to make interest payments and repay debt? Okay, so then like the ratios for solvency are ratios such as ratio of fixed assets to long-term liabilities, ratio of liabilities to stockholders' equity, and times interest earned. Okay, so like we can see the equation for those. And finally, it's going to be based off probability. Probability, the ratio of probabilities. Evaluating a company's ability to generate earnings. Like, how good or how well does this company generate earnings? Like, how profitable is this business? So, like, the ratios associated with that include asset turnover, return on total assets, return on stockholders' equity, return on common stockholders' equity, earnings per share on common stock, price earnings, okay, dividends per share and dividend yield. So there's all these different ratios and all these different equations that are very important. We're going to go through a problem set here. You can see. So we're going to have to use the following selected financial data to compute the following ratios. So let's look at the first ratio. The return on stockholders equity. Okay. So return on stockholders equity. This ratio is net income over average total stockholder equity. Return on shareholders equity. Return on stockholders equity. Net income over average total stockholders equity. Next, return on common stockholders equity. Return on common stockholders equity. Net income minus preferred dividends. Okay. Average common stockholders equity. Next, earnings per share. Earnings per share, EPS. Okay. Net income minus preferred dividends. Shares of common stock outstanding. Price earning ratio. Price earning PE ratio. This is going to be market price per share of common stock divided by earnings per share on common stock. Lastly, well, those are the four ratios we're looking for. So let's start with the first ratio, return on stockholders' equity. So it's actually somewhat straightforward and simple, right? So like, how do you calculate return on stockholders' equity? You guys are gonna have to like memorize some of these ratios, but so return on stockholders' equity, net income, right? 5,200,000 divided by average total stockholders' equity. So the average total stockholders' equity, if you guys look here, you guys are gonna see, let's see, average total stockholders' equity. It's gonna be common stock here, as well as additional paid over, what is it, APIC? Additional, excess paid over par, pretty much. It's like how much you guys paid over par. It's 9,000 plus preferred stock, 10,000, 10 million, 10,000 K. And or was it total stockholders equity? 5.2. What is it? Stock on par. Average total shareholder equity. Average total stockholders equity. Is that correct? Is that correct? 18 million? Average total shareholders equity. It's 43. Yeah, that's correct. So it's gonna be all these, right, or including this. So it's gonna be common stock. It's gonna be additionally paid in capital, common stock. It's gonna be preferred stock. It's gonna be additional paid in capital, preferred stock, as well as retained earnings. Those are the total of all stockholders' equity, as in like the common stock of the company, as well as the additional paid in capital of the common when it was paid in, and the preferred stock, as well as the capital that was paid in on preferred stock as well as retained earnings. So 43,750,000. Okay. So to find the ratio, return on shareholders' equity, it's gonna be 11.8 plus 9%. That's the return on shareholders' equity, on the total, an average total of the shareholders' equity. Okay. What that means is that for every dollar of equity, there is a return of 11 cents. Okay. So return on common stockholder equity, okay, common shareholder. So to find this ratio, we're going to have to get net income, which is 5,200,000 minus preferred dividends. Okay. Return on common stockholder equity. Okay, so preferred dividends. So we're gonna have to calculate the dividends. Okay, so it's like the preferred. It's not the stock. It's not the dividends coming from the common stock, but it's the dividends coming from the preferred stock. Okay. So how are we gonna calculate the preferred dividends from that comes from the preferred stock? If you guys look here, preferred stock, $5 par at 5%. $5% means that for every share you get 5% of the value. So like if it's $5 par, there would be 2 million shares of preferred stock, but because there was additional paid-in capital of 5 million, okay, so there is gonna be 2 million stock that was issued at $5 par, but actually it was a it was paid on premium, okay, and that premium was $5 million. So it sold for actually how much did it actually sell for? Gosh, that's a good question. Let's see. 5 million divided by 2 million plus 5. So it actually sold for 7.5. It sold for $7.50 per share of preferred stock. $7.50 was the actual price of the share that was purchased at. But it's paying out based off of the par. So based off of par, if it's $10 million worth of preferred stock, and there's a dividend payment of 5%, 500,000 is actually the dividend of the preferred stock. Now, to get the average common share stockholder equity, you actually have to, because it's not like the average, when you think of average common stockholder equity, right? So you would think like, oh, I just have to add this together. Like the common stock like how much common stock there is, as well as how much additional paid-in capital of the common stock there was. Right? But actually, to actually find the average common shareholder equity, you gotta go with retained earnings minus retained earnings plus common stock. Okay. So retained earnings, but not including preferred stock. So that means that average common stockholder equity is going to be 28,750,000. Return on common stockholder equity, 5,200,000 minus 500,000 divided by 28,750,000. So the return on common stock equity is 0.163. So earnings per share. To calculate the ratio for earnings per share, you have to get the net income, which is 5,200,000 minus preferred dividends, which is 500,000. Shares of common stock outstanding. So how do we calculate outstanding common stock? Because, like, for example, if a stock has been issued and it's out there and it's out there circulating, that's the outstanding stock. The outstanding stock could be repurchased by the company and converted into treasury stock. Okay. But, like, to calculate common stock outstanding. You could use this little formula. Okay. So how much common stock is there? All right. As in, like, we have to find out how much common stock there is. This common stock is 50 cents par, and there's $1 million worth of capital for this common stock that was purchased at 50 cents par. So that means that if this stock was issued at 50 cents par for each stock, it means that 1 million divided by 0.5. So there's 2 million common stock shares. So 5,200,000 minus 500,000 divided by 2 million. 2.35 is the earnings per share. Because the earnings per share, you get the common stock and divide the preferred dividends. The preferred dividends coming from the preferred stock, you minus that from the income and divide that by the amount of common stock shares. Okay? Because the dividends is going to be coming out of that income. So that means that the earnings per share is $2.35 per common stock shares. So the price earning ratio, to calculate the price earning ratio, market price per share of common stock. Okay. So the market price per share of common stock is $70. Okay. And the earnings per share on common stock is $2.35. So the price earning ratio is 29.79x. You guys see? So it's earning 29 times the price earning ratio. Okay. The share of common stock Anyways, there are other ratios. For example, working capital ratio, current assets minus current liabilities. It's an important one. Quick ratio, current ratio, accounts receivable turnover. All these are very important ratios, but I'm going to end this video here. If you guys have any questions, you guys can feel free to reach out to me. Thank you.